The current live trading price for SoFi Technologies Inc., ticker symbol SOFI, is locked in an after-hours holding pattern, having closed the previous session on Thursday, November 28, 2025, at $28.33. This price represents a significant surge from the day's opening, with the stock moving over 3% in the last session, and the key insight right now is that this upward pressure is persisting despite the broader market taking a breather, which immediately challenges the simplistic narrative that SoFi is purely a risk-on momentum trade tied to the Nasdaq. The reality is that the stock's resilience is rooted in the market's growing certainty about its path to sustained, gap-based profitability, which was demonstrably solidified in the Q3 earnings report, where they handily beat both revenue and adjusted EPS expectations. The Street expects a tech-heavy company like this to be volatile, reacting wildly to macro shifts, but the recent action, holding firm above the $28 mark, suggests that institutional players are now focusing less on the speculative fintech tag and more on the company's execution in its banking charter operations. The common expectation among retail investors and casual observers is that SoFi is essentially a student loan refinancing entity that pivoted, relying on a low-interest rate environment to thrive. But that perspective is outdated and falls dramatically short of the company's current operational reality. The company's actual strength lies in its vertical integration as a technology-driven bank, specifically how its core banking products and its Galileo technology platform are creating capital-light, predictable revenue streams that fundamentally de-risk the lending business. This is the crucial contrarian take. While everyone sees a lender, smart money sees a rapidly scaling tech platform with a sticky customer base, funded by cheap deposits from its bank charter. This shift is evident in the strong sequential member and product growth reported in the last quarter, which is the engine driving the consensus beat and the reason the stock has shown a robust year-to-date return, significantly outperforming many of its purely loan-focused peers. Looking at the recent stock movement, the push to close near the high of its range yesterday with strong volume indicates a conviction buy-in. It was not a weak bounce, it was a decisive move, likely fueled by a continuous rotation into growth stories with a clear profit margin runway, especially as the narrative around a possible Federal Reserve rate plateau gains traction. The trading range over the past few days has tightened, consolidating near the $29 level, which is a key psychological and technical resistance point. A definitive break above this level on increased volume could signal a fresh leg up toward the 52-week high of $32.73, while a fall below $27.50, a level that has provided support since the Q3 report reaction, would suggest profit-taking. Institutional activity for the third quarter was fascinating, showing massive share additions by major firms like JP Chase, BlackRock, and Susquehanna, which overwhelmingly signals a high degree of institutional confidence in the management's guidance and overall strategy. This contrasts sharply with the public insider selling, where multiple executives and officers have sold shares, albeit primarily through automatic or scheduled disposition of stock acquired from options grants. It is important to contextualize this. These sales are often for tax purposes or portfolio diversification, and should not be automatically interpreted as a lack of faith in the company, though the sheer volume of net selling certainly warrants attention. This brings us to the crucial element of short-selling awareness, an ever-present factor for high-growth, high-volatility names like SoFi. The short interest remains elevated, sitting at approximately 9.80% of the float, representing over 116 million shares shorted.
This is a substantial position, yet the key metric here, the days to cover, is a relatively low 1.77 days based on recent average trading volume. This low days to cover figure suggests that while short sellers have a large bet against the company, the sheer liquidity of the stock means they can theoretically exit their positions without causing a catastrophic short squeeze. This is the actionable insight for retail investors. The technical conditions for a massive, uncontrolled squeeze are not currently aligned. The borrow rates, hovering at a minimal level around 0.25%, are also not screaming short squeeze alert, because cheap borrow rates mean short sellers are not facing significant pressure from the cost of holding their positions. The primary short thesis revolves around valuation. Bears argue that a bank with a price-to-earnings ratio over 50 is vastly overvalued, especially given macroeconomic headwinds to consumer credit and the lingering uncertainty in the student loan market. Retail investors need to monitor the short interest percentage and, more critically, the days to cover figure, which will be updated soon. An increasing days to cover paired with a sudden spike in borrow rates would be the true indicator of mounting short pressure that could precede volatility. What's your take on the rising short interest? Smart money or just a lingering bet that hasn't paid off yet? Comment below with your thoughts. The company's business model is a vertically integrated financial services holding company. Its core pillars are its lending segment, its technology platform, Galileo and Technesis, and its financial services segment, checking, savings, investment accounts, credit cards, and insurance. The brilliance of the model and the source of the market's current fixation is the flywheel effect. They acquire a member through a high-margin product, typically a personal or student loan, then cross-sell lower-margin, sticky banking products like savings accounts, all powered by their internal technology platforms. The bank charter, acquired in early 2022, is the linchpin, providing a stable, low-cost source of funding for their loan portfolio through member deposits, drastically cutting their dependency on higher-cost wholesale funding and interest rate sensitivity. Past performance, particularly the revenue acceleration post-charter, validates this strategy, moving them from a high-growth, high-loss fintech to a high-growth, near-profitable digital bank. The future outlook for SoFi pivots entirely on its ability to sustain its bank-like efficiencies while maintaining its tech-like growth. The core opportunity for the future is the Galileo segment, which provides critical infrastructure as a service to other fintechs. This B2B, platform-based revenue is high-margin and less dependent on consumer credit cycles, offering a crucial diversification. Analysts are divided, with price targets ranging from $12 to $37, reflecting the tension between old-school valuation models applied to a bank and growth-based multiples applied to a tech platform. The immediate catalysts to watch out for are next quarter's earnings, where the market will be hyper-focused on the company achieving its first full quarter of GAAP net income, and any regulatory shifts surrounding student loan policies, which could provide another unexpected tailwind to its original core business. The primary risks remain the macroeconomic environment, particularly persistent high interest rates that pressure their lending margins, and a potential uptick in consumer loan delinquencies, which every digital lender is currently navigating. The key for investors is to understand that the expectation for SoFi is rapid growth, but the reality that matters is the sustainable, profitable foundation they are building with their bank charter and technology platform. That reality is what keeps the stock moving forward even when the broader sentiment is shaky. Comment below how many shares of SoFi Technologies you currently hold, or if you are waiting for a pullback to the $25 level. The current market action suggests that the expectation of SoFi remaining a volatile, speculative stock is slowly giving way to the reality of a fundamentally solid, rapidly executing digital finance leader, one that is strategically separating itself from the rest of the crowded fintech field. We must closely watch the $29 resistance level and the short interest trends next week, as the confluence of institutional conviction and a tightening short leash could create the fuel for the next significant move in either direction. The story of SoFi is no longer about potential, it is about proof.